What I'm going to do next is take my timeline with the written descriptions, and I'm going to start adding in the numeric details. So for example, my initial investment is going to include the cash inflow from the sale of the old machine, net of taxes. It's going to involve the outflow of the cost of the machine, the outflow for the installation expense of the machine, and the outflow of the increase in net working capital. So I'm able to put numbers on each of those, and I come up with a net cash outflow of $1.1104 million. $1,110,400 is outflowing in this case. Now I've labeled that with I sub 0, that little IO next to the bottom line of our cash outflow there stands for the investment at time 0. After that, I'm given the $350,000 benefit that the machine is going to produce for us. That was given as a reduction of expenses in the paragraph. So I've got a line simply for the $350,000 that I'm expecting for each of the 5 years. And you notice that I do have that for years 1, 2, 3, 4, and 5. A common mistake that students will make is that they'll leave out that incremental cash flow, that benefit, on the 5th year. Don't forget the 5th year, and don't forget the terminal value. Now the terminal value was simple to produce. We had the cash inflow from the sale of our replacement machine and the $25,000 that we no longer need to tie up in net working capital. So our terminal value is $172,000, and that's going to be, again, above that 5th year cash flow. That's not all that we need to do. The other thing that we need to do is consider what effect depreciation has on tax expense. Now remember, I said you'd need that depreciation number, and even though depreciation is not a cash expense, it affects something which is a cash outflow. Our tax expense is going to be a cash outflow, so depreciation has an effect on a cash flow. We need to take that depreciation expense and we need to work it into our computations. So what we're going to do now is build a sort of a table that's going to tell us what the cash flow is for the new machine, the cash flow for the proposed project. For each of the 5 years, we're going to have a reduction in operating costs of $350,000. And we're going to have a depreciation expense, which we figured out when we were working with our makers table. The $270,000 is what we got for that first year of 20%. The second year depreciation was 32%, and we got $432,000, and so on and so forth. If we take the improvement to our EBIT, in other words, the reduction in our operating costs, if we take that improvement and we subtract depreciation from it, we're going to have what our net profit before tax would be for this project. So $350,000 in the first year minus the $270,000 depreciation for that first year leaves us with a profit of $80,000, and it's going to be taxed at the 40% rate. So net profit after tax for that first year is $48,000. And if we add back our depreciation, we're going to come up with our operating cash flow. So net profit after taxes of $48,000 plus the $270,000 depreciation gives us $318,000. Looking at the second year, we've got a larger depreciation amount. That 32% depreciation amount winds up being more than what the reduction in operating costs are going to be, but this is not necessarily a bad thing. We do have a negative net profit before taxes, but what this produces for us is a net tax benefit of $32,800. And when we're looking at our net profit after tax and we add back depreciation to arrive at the cash flow, we actually wind up with a positive cash flow of $382,800. So the operating cash flow from year 2 is greater than the operating cash flow in year 1, even though the project looks like it is less profitable. From there, we can continue on for years 3, year 4, and year 5 in order to figure out what the operating cash flow is for each of those periods. If we're going to figure out our incremental cash flow, we also need to know what our business's usual cash flows would have been. In other words, if we choose to not engage in this project, what will our business look like? In this case, there is no effect on the operating costs. The operating costs are going to be exactly what they would have been before. So you'll notice the line where I had the net reduction in operating costs before. Now that line is blank, and I've just got depreciation, net profit before tax, tax, net profit after tax, and operating cash flow. Working my way down the table, I've got the depreciation which remains on the old piece of equipment. Now there was detail in the paragraph talking about how many years the equipment had left as a useful life, and you can work through the remaining years of makers in order to figure out what the expense would be in each of those years. Because we have no improvement to our EBIT from this project, our net profit before tax, the relevant number, is going to be 0 improvement minus the depreciation expense. In the first year, we've got $0 in improvement because we're sticking with business as usual. We subtract depreciation from it, and we've got a net loss of $152,000. Remember, we're not looking at the overall business operation. We're just looking at what is relevant to our project. We're just looking at what is going to change because of our decision. If we do not choose to engage in this project, we're still going to have the old depreciation to deal with. When we tax that loss at the 40% rate for each year, we get the numbers shown. Our net profit after taxes is as shown, and our operating cash flow takes that depreciation and adds it back to the net loss. So $152,000 plus the negative $91,200 in the first year gives us an operating cash flow of $60,800. Second and third year would have $38,400, and the fourth year would have $16,000. In the fifth year, the piece of equipment is fully depreciated, and so there is no depreciation expense. Therefore, there's no loss, no tax implications, and no incremental operating cash flow that we'd have to think about. To figure out the incremental cash flow, what we're going to do is take the relevant cash flow for the new machine and the relevant cash flow from the old machine and simply subtract the two. That's the table towards the bottom of the screen. In year one, we had $318,000 for the new machine, and we had $60,800 for the old machine. We do the subtraction, we come up with what our increment is, what our difference in the cash flows is. So the difference, or incremental cash flow, is going to be what the net benefit is going to be from making the change that we've proposed. Get rid of the old machine and bring in the new machine, and we're going to wind up with that incremental cash flow as shown. So the next step is simply to build the table that we're going to use to discount our cash flows. We figured out our initial investment. That's a year zero cash outflow. We figured out what our incremental cash flows were for each of those years, 1 through 5. And we figured out what our terminal value was, which is going to be a cash inflow that happens at the end of year 5. Our total cash flows are as shown. We can discount those at the hurdle rate of 9%, and we come up with a positive net present value, an internal rate of return of 12.24%, and we can even figure out the payback period of 3.91 years. When we're making the objective decision based on our work, we're going to look at our criteria. Do we have a positive net present value? Yes, we do. Do we have an internal rate of return greater than the hurdle rate? Our hurdle rate was 9%, so yes, we do. Is the payback period acceptable? That's a question which is only going to be answerable if you have information from management. Now, we're not told what management's criteria would be for a payback period. So in this case, I would simply use it to give some sort of a more complete picture. It gives me a frame of reference that I can use to help gauge what those cash flows are. For example, if the payback period only happens in year 5 and it only happens because of that terminal value, that's going to add some color to the commentary that I'm going to give around a project.